In this week's video, we'll review the latest charts and studies to help us answer the question, has the next big leg down in stocks already started? This was the summary slide from last week's video, and some of you may have found it odd after we presented all the potentially bullish breadth studies to see this as the first bullet point. In fact, most of these bullet points acknowledge that we're still in a challenging environment in 2022. Interest rates are going to be a problem for the markets until proven otherwise. Thus far, there's really no evidence at this point to say that this trend in interest rates has calmed down in any shape, form, or fashion. Some reference points: the high here from late 2013, around 3%, and the high here in 2018, a little bit over 3%. We'll cover this ratio in more detail later in the video. Just wanted to show you the chart as of the close on Friday, April 8th. Also noteworthy in this pattern, over here things look discernibly different than they did over here. On this side of the pattern, you're below a downward sloping 200-day in red. The intermediate term trend coming into the consolidation box is down 50-day in blue, and thus the probability of failure up here is higher than it would be theoretically over here on the right side. 200-day trying to turn up now, and when all of this is going on here, the intermediate term trend in the rearview mirror has been up rather than down. It's a daily chart of the VIX as of the close on Friday, April 8th. If you're a stock market bear, you'd like the right side of this chart to morph into something more like this. Notice RSI thus far has stayed relatively tame, and this is RSI for the VIX here, and below 50. Concerns about the stock market would increase if it morphs into a look more like this. It looked like the VIX was going to try to break this trend line here, and that's still possible when we consider in the last 3 sessions here, the VIX made a lower high each day, it made a lower low each day, and each day the close was lower. Close is lower here relative to here, close here, lower relative to here. Contrast the look of the volatility index for the VIX at the beginning of the year. So VVIX, this is increasing fear here about future volatility in the VIX. It's increasing rapidly in January of this year. Currently, it's still hovering around the lowest levels in 2022. When we review broad breadth data since the low, some improvement is still necessary, and that might be a little bit of an understatement. However, it's important to keep in mind this look over here, still in a downtrend, can make an argument it's not really discernibly different than this look here, which occurs after the major low in March of 2020. This is the advanced decline volume line for the NYSE composite. You may find it a little surprising that the same line for the Nasdaq broke out to a new high, and thus creating a significant positive divergence by making a higher high relative to price that's still making lower highs. We've removed price from this chart. We're just looking at monthly moving averages, EMA 8, EMA 9 for global stocks. This is the peaking process here in 2007, and this is a concerning rollover look here. It's possible that we're retesting the breakout above these levels here. But if you study this chart, in no uncertain terms, this is a concerning look. You can see where we roll over here, what happens with the S&P, roll over here, S&P here, and you can look at all of the examples. So this is relevant and concerning until proven otherwise. That would be the bad news. The good news would be the same 2 moving averages for the S&P 500 index as of the close on April 8th look really infinitely better at this point. This is subject to change, but it hasn't changed significantly yet. It's a daily chart of the triple Qs of the Nasdaq 100 after the close on Friday, April 8th. Bad news, rejected at the 200-day moving average, similar to this look over here. Potential good news, the 50-day moving average looks much better. It's trying to turn up here, and price is still hanging around in that general area. Could also make an argument that this is potentially a left shoulder This is your head, and we could be forming a right shoulder over here, and it would be helpful if we held near this 50-day. That falls into the to be determined category. If you look at the Nasdaq 100 relative to the S&P 500, you could make an argument that this is a bullish breakout, and on Friday we're retesting that breakout. The look of RSI here, somewhat similar to the look over here, and this is a concerning look here with the 200-day moving average, but we had a similar look over here, and the ratio did rally. Not a prediction in any shape, form, or fashion. A negative here would be, this is a discernible lower low here relative to this low. You'll find in this week's video that we're covering a lot of concerning aspects relative to the present day market and a lot of encouraging things that have happened as well. And that's summed up here in the NYSE Composites 200-day moving average. Price on Friday, April 8th closed right on or slightly above a flattish 200-day. That's about as indecisive as you can possibly get. And that aligns with a lot of the data that we have in hand. We'll learn a tremendous amount relative to what happens going forward from here. And there's nothing that says this has to be resolved in short order. It's possible we could trade sideways for several months before resolution. Right now, we're hanging around the 200-day and thus far holding above this downward sloping trend line. If you follow the markets closely, you may have noticed that semiconductors, home builders, and banks have all been relatively weak in recent weeks and months. Hard to say that that's not concerning relative to recession probabilities. And we also had a big spike up in the transportation index that we showed in a weekly video recently, and that's been given back. It was followed by a big plunge in transportation stocks. And those are facts that we have to consider, and they seem to align with this uptrend in the intermediate term in this defensive ratio. This is a weekly chart of XLE going back to 2003. It's incredible how much change has occurred on this chart in calendar year 2022. Here's where price was at the end of last year, here, in the area of the 2019 high, below the 2018 high, in the neighborhood, potential resistance, the 2016 high, below this high here in 2015, significantly below this high and potential resistance from 2014, still in the neighborhood of this here in 2011, and for the most part below this potential major resistance from 2008. Fast forward to the present day on April 8th, and we've blown through all of that potential resistance. Regardless of what happens from here in the short run, there's no denying that this, in its present form, is a long-term bullish breakout. This is a consolidation pattern that for the most part goes back to 2008. The longer it holds, the more meaningful it becomes. Also noteworthy, we're breaking out as the 200-week moving average is trying to turn back up. From a risk-reward perspective, when we're moving up here, this is all potential resistance, overhead resistance here. Now the script has been flipped. What once acted as resistance in all of these levels may now act as support if we come back down to earth. Always concerning when you see a near vertical chart, but that doesn't negate all of the things that we just talked about. None of it really speaks much about the short term. It speaks to the intermediate and long term. There's a reason why we have the term failed breakout. But right now, this is a successful push above this high that dates back to 2014. Energy versus tech daily going back to this peak here in 2014. Resistance, resistance, resistance. This looks a little bit different. Energy versus the S&P 500 on a weekly time frame with the 200-week moving average in red. The ratio now above a downward sloping 200-week, but it looks different than anything that we've seen in this window here dating back to 2012. Still have some work to do if it's going to morph into a full-bore bullish look, and that would be the ratio rising and above an upward sloping 200 week. For the most part, the same concepts apply here. Energy relative to the S&P 500 monthly and the 50-month moving average. This is energy stocks divided by the S&P 500. We're using mutual funds because they have a longer-term history. If the present day over here on the right is eventually going to morph into one of those full-bore bullish looks, then this is a step in the right direction here, and this is a step in the right direction here. Under our approach, the more the present day morphs into something like this, the more we're willing to allocate to the investment. And we'd be willing to allocate even more if this look over here can complete the next two steps. So this is step one of a trend change. In this case, breaking the downward sloping trend line. Step two after that occurs would be to make a higher low relative to one of these lows in the rearview mirror and eventually make a higher high. And to get to that full-bore bullish look, we'd also like to see the moving average turn up. Nothing's etched in stone, but this look here does look better than these counter trend moves here that all occurred below a downward sloping moving average, and in each case didn't even get back to the moving average. These are counter trend moves, and we know counter trend moves tend to be followed by more pain and lower lows. If we can morph over here into something like this, then your counter trend moves would be followed by higher highs and higher profits. This is the summary slide from last week's video. It's dated April 1st of 2022. You might remember we covered 25 breadth thrusts here on the left side of the screen. Historically, performance was very, very impressive. When you hear the term breadth thrust and you see green boxes like this, you might assume that the market's going to go up very, very rapidly and in a very, very confident manner. And in some cases, that does happen. But this box over here that we covered last week says it's not unusual for the market after the initial thrust to have a fairly significant give back and a fairly long duration of fear. This is 16 calendar days. Median drawdown, 65 calendar days, is the average drawdown. Thus, from a historical perspective, there's several additional boxes that we would like to see checked somewhere between 2 to 10 weeks out from the initial thrust. Here's one example. Defensive assets as of April 7th, this is being recorded this portion of the video on Thursday evening. For the most part, defensive assets are still leading. And that's not particularly shocking, because defensive assets have been leading since the market started to get weak back in November of last year. This is where the Nasdaq peaked. Thus, somewhere typically in this window, 16 calendar days out to 65 calendar days out, all things being equal, we really prefer to see defensive leadership take a step back. Something that hasn't happened yet. In fact, you've probably noticed on this chart, pretty easy to pick out an inverse head and shoulders pattern, a bullish inverse head and shoulders pattern, left shoulder, head, right shoulder. Looks like we're trying to break above the neckline. That would be the bad news for the bulls. Right now, the good news for the bulls would be we tried to clear the neckline 2 previous times and failed. So overall, this is a concerning pattern for the stock market bulls. This is also a little concerning here. We have this pattern in the 200-day moving average for the ratio. It's trying to turn up. If we look at it from a trend perspective, step 1, the ratio breaks the trend line. Step 2 here would be a higher low relative to this low. And step 3 would be to clear this high here that was made back in March. Now, if this breaks out, it's not necessarily a showstopper for the rally, but the longer defensive leadership remains in place, the higher the probability that the rally will fail or disappoint, or fail in a significant manner maybe several months down the road. You can pause your video player here. This just gives us some idea of what to look for. This is the ratio here, again, daily chart, the 200-day moving average. You can see the defensive move here as the S&P 500 is peaking in 2011. And then you can see fear subsiding, the ratio dropping here as the market makes a low. Your low for the market isn't here. Red lines are your peaks. These are your bottoming process looks in blue. These would be the two cases that you want to study in terms of a retest of the low. 2011 has somewhat of a retest look. You fall in the July-August time frame here, and then you have another plunge into October, early October of 2011. Similar situation here. You plunge, you get some breath thrust activity here, but you don't make your final low until February of 2016 here. So you can compare and contrast the look up here when the bears are in control, and then what does it look like when the bulls start to reassert some control. Similar situation here and here. Does the present day look more like this? A spike up, a retracement, and then we're going to move higher? So this is the present day, a spike up, a retracement, and then we're going to move higher. In that case, the market falls quite a bit further. Or do we look more like this, where we had a spike up, a retracement, we're going to make a lower high, and the market's going to bottom? So these looks just give us a reference point relative to what we have over here. Right now we have a defensive ratio that's above a 200-day moving average, and looks like it's trying to break out in favor of defensive assets. Probably fair to make the argument that these concerning looks in here in orange, when bad things are happening in the market, concerning look in orange, bad things are happening, little sliver of concern here, bad things are happening. We still have a similar look in the present day. Notice what the 200-day is doing here, 200-day turning up, 200-day turning up. Doesn't mean we're doomed here, because you can see there are periods here, here, and here that have a similar look to the present day, and the S&P 500 rallies in those instances. Nothing etched in stone here. We're just trying to find some clues to help us discern between a case like this, and these cases here. Same ratio. Now we're looking at a weekly chart with the 200-week moving average. The S&P 500 index really peaks right about here as we cross the 200-week in October of 2007, and then the market falls into early 2008 and then rallies here. So notice on this rally attempt here in the spring of 2008 in the S&P 500, look at this ratio here. It's getting more fearful during this rally attempt here. So we look a lot better over here. We're below a still somewhat downward sloping 200-week moving average. We do have momentum here telling us to keep an open mind. This look here looks really stronger than what we had over here. Here's your peaking process in 2011. Here's where things started to get shaky in 2015. Notice we're crossing. Similar thing here. We cross near the COVID plunge. This is the look today. Same concepts here. Monthly chart. Here's the peaking process in 2008. You can see we're above a 50-month, 40-month, and 10-month. And eventually the ratio gets above all of them and the slopes turn up. Now that's quite a bit different than what we have in the present day. However, you can make an argument that this look here in green, where my cursor is, could be similar to this look here in green. So this is the look that you want to avoid if you're a stock market bull. This is what the bears want to embrace. This here, somewhat similar to what we have in the present day. This is a little bit like that monthly chart that we showed on the S&P 500 last week. This is a little bit of a concerning look, a similar look in the present day. S&P 500 eventually has somewhat of a double decline here in 2015, 2016. Here, eventually, you get a significant drawdown, almost a bear market, into early October of 2011. Keep in mind, this is a monthly chart, so it's not really showing the movement in the S&P 500 nearly as much as would be evident on a daily chart. But you can pause your video player here, but there's just some things that we'll be looking for. The more we look like this, the more concerning it becomes. But either way, we can learn something about how confident people are during the rally. The higher the degree of confidence, the higher the probability the rally will continue. If you're being led by defensive assets, that's a yellow flag. So this is defensive momentum turning up on a monthly chart. Defensive momentum turning up, defensive momentum turning up. similar look here in 2022. Those concerns would be similar here to a growth asset, the S&P 500, experiencing a rollover in monthly momentum as evidenced by MACD here. Contrast that with the weekly look that's trying to turn up. So we should learn something either way based on all these looks in the coming days and weeks. This is a daily chart of the S&P 500 during the session on April 7th. We would put this in the encouraging category. Here's the COVID low here. I think we pointed out this divergence in a video previously, or possibly on Twitter. You can see there's a divergence here in 2022, similar to the divergence here in 2020. Market bottoms here where my cursor is, March 23rd low here. RSI on the daily chart comes above 50, comes back to it, tags it, and bounces. You can make an argument over here, above 50, coming back to 50, and thus far, we're bouncing here. Nothing earth-shattering, but this over here definitely looks different than, for the most part, everything that we've seen since the market started to correct in early January of 2022. If you're a stock market bull, this is what you want going forward. If you're a bear, you like this look here. Thus, it's important for us to know that the concept we covered last week, technical analysis tracks the past, does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. And that concept applies to bullish looks. It also applies to this concerning look here and this constructive setup here for a defensive-oriented ratio. That's why we use a weight of the evidence approach. So back to the summary slide from last week's studies. Let's check in thus far on the drawdowns. These are the reference points that we're using. This is the S&P 500 as of the close on April 7th. As you can see, really nothing out of the ordinary yet relative to the 25 breadth thrust signals that we covered last week. This would be the past activity of some traders over here, and this tells us what that may say about the future activity of other traders. If you sketch it out based on the signal dates over here, your drawdown window in the present day would be somewhere, hypothetically, between April 7th and April 14th. As we mentioned last week, nothing magical about these levels. We'll learn something either way. If we move into this area here, we start to drift a little bit from that historical script. I always want to give credit where credit is due. Relative to what we're covering now, this is where credit is due. This is the Twitter handle here. Here's the website here. Here's the event they identified. Q1 2022 was only the 12th quarter post-WW2 that saw the S&P 500 fall 10% from a closing high and rally back 10% from its intra-quarter low. They were nice enough to identify the quarters in the past where something similar happened. So using these dates that they identified, this is the S&P 500's historical performance walking forward from quarter end in each of those historical cases, emphasizing that quarter end in 2022 is similar to what happened in these quarters here. The S&P 500 was higher 100% of the time, 6 months later, 9 months later, 1 year later, 2 years later, 3 years later. 90% of the cases up 4 years later, 80% 5 years later. Average gain 1 year out from the date of the signal or quarter end, almost 30%. The median gain somewhere in the neighborhood of 27%. How about the maximum 1 year drawdowns? Average drawdown 4.64%, the median drawdown 2.87%. But notice this drawdown. The signal comes 12/31/2008, and after that rally, after that somewhat thrust-like activity or key reversal in a quarter, big drawdown here, 25.1%. So here's the date of the quarter end, 12/31/2008, that's similar to the quarter end that we just experienced in 2022. It's noteworthy that those periods are significantly different. This is December 31st, 2008. This is the 50-day all the way out to the 250-day. Look how long the stock market has been falling when you get that reversal into quarter end. So this would be similar to the reversal that we just experienced. It's pretty easy to see that the market's profile and the attitudes and psychology, hopes and desires and fears of investors over here are quite a bit different than they are in the present day. Still a legitimate signal, but it's also good to understand the context of this really, really big drawdown. It typically takes time to dissipate this massive downward momentum, and that's exactly what happens after that rally. Thus, we wanted to know what happens to these numbers if you remove that case. Average drawdown 2.59%, median drawdown 2.46% from quarter end in the historical cases. 14 days here, roughly 8 days here. We put all of this hypothetically on a present day chart. This is what those historical drawdowns would look like in the present day. And we've removed this case for a reason. This is what the bullish cases looked like. If we start to move into this area here, then we have to respect that something like this could happen in the present day based on this information here. All right, we've got some new breadth studies to cover this week. Concepts are very similar to what we covered last week, so we will be moving very, very quickly. This is a weekly chart of Nasdaq stocks above their 50-day exponential moving average. We're using all of the data that we have going back to 2002. As you can see, it's rare to get a move from here to here, which would be similar to this move from here to here. Using all the data we have, only 5 similar cases. S&P 500 was higher 1 month later, 3 months later, 6 months later, 1 year later, 2 years later, and 3 years later in every case, respecting that this is a small sample size. Drawdowns similar to what we've seen in other studies, and the number of calendar days similar as well. This indicator aggregates new high and new low data from major averages in the United States. Relatively rare to move from down here, somewhat of an oversold and rare look, to the red line up here, using all of the data that we have going all the way back to 1992. Should be noted, during the dot-com bust bear market, how many times did this happen? Answer, never. How many times did it happen during the financial crisis bear market? For the most part, never, because it happened at the bottom. S&P 500 on a closing basis, the lowest close in the S&P 500 is here, March 9th of 2009. We get a thrust after that and hit the red line. Here are all the historical cases. Drawdowns were very muted. Performance, once again, satisfying. Average gain a year later, 25%. Median gain, 21.8. In this case, we're only looking at cases going back to 2002. Why? Because we're trying to understand if this move here is indicative of a shift in risk appetite. That's really all we're trying to determine. Said it another way, going back to 2002, when you saw a move like this, did it make sense to respect it or to ignore it? Looking at a small sample size, but it is evidence of a shift in risk appetite. And in these cases, the shift was meaningful and lasting. Drawdowns, relatively tame. Same concepts here. Purpose of the exercise, trying to discern how relevant is this move from here to here. And the table and the drawdown table help us answer that question. This was the historical pain over here, 56 to 12 calendar days, so the market didn't go straight up, which means while something like this is concerning, it's not really out of line with 12 to 56 calendar days in this type of drawdown, because when you're getting drawdowns, it's obvious that defensive assets are getting some attention in here. This is real fear. 1 month later, 71% of the cases were higher. Looked very, very good after that. This data tracks Nasdaq 100 stocks greater than their 150-day simple moving average. Using all of the data that we have going back to 2002, we do have a legitimate, keep an open mind about a wide range of outcome signal here in May of 2008. If you know your market history, this is similar to the present day. It occurs after the major peak in October of 2007. You can easily make an argument that this rally here into May of 2008 is similar enough to the present day to respect these ugly numbers here. How ugly? Very ugly. 51.42% drawdown from the date of the signal. That takes your average drawdown to 9% and change. Your median drawdown still looks about the same as the other cases, about 2.43%, 14 calendar days. Helps us keep an open mind about a wide range of outcomes, including much worse than expected outcomes. There are some significant differences between this period, but there's enough similarities to respect these red numbers here. NYSE breadth thrust indicator. It's a very, very volatile indicator. Looking at a moving average of the indicator here. This is a rare move, something that just happened in the present day. In this case, we're looking at data going back all the way to 1982. And for the most part, there's a lot of green in the table here after the signal, with two significant exceptions. August 29th of 2008, January 1st of 2009. Since these drawdowns are very, very significant, it might be helpful to point out that these cases are quite a bit different than some of the other cases. Here's a low in 1982. The 200-day moving average is recaptured on the rally. This is after the 1987 crash. You can somewhat make an argument this is similar to the COVID low. The rally does make it back to the 200-day. Recession, 1990. Some similarities to the present day in here. After the low, you make it back above the 200-day. 1998, a short stay below an upward sloping 200-day. And then when we come over to these two cases here, they don't look anything like these other cases. Here's the date of the signal out here. Now notice, when the signal date comes, you don't even have enough conviction in the markets to get back to the 200-day moving average, and the slope of it is clearly down. Similar situation here. Here's point A, here's point B. Really doesn't look anything like the present day, where we had the low and then we made it back above an upward sloping 200-day. Still legitimate, and hence why they're included in the data set. But since there are some noteworthy differences here, when we aggregate all of this data at the end, we'll show it with these two cases included, and then we'll show it with these two cases removed. New York Stock Exchange common stock only. New highs minus new lows. Red line back to the blue line. In this case, we're looking at data going back to 2009, trying to see what it meant, if anything, relative to risk appetite. 100% of the cases higher 3 months later, 6 months later, 1 year later, 2 years later, and 3 years later, 1 year out. 15.72%. The median gain 16.55. 3 years later, in the neighborhood of 45%. Drawdowns a little bit bigger in this case. Duration a little bit longer, 91 calendar days and 29 calendar days. Remember, we said it's not unusual for the market to have a period where it looks like we're back to risk off after these thrusts. But obviously, in the historical cases, at some point you have to shift back to risk on to produce these type of numbers and all this green over here. Thus, in this context, defensive leadership is not that shocking at this point, but we'd like to see a shift there. It hasn't happened yet. And the fact that it hasn't happened yet is a relevant part of the weight of the evidence. And in terms of the next steps, we still have work to do relative to many breadth statistics. This NYSE new highs, new lows on April 7th. That's not really attractive. So how concerning is this in this window here? Like anything else, it's concerning until it's cleared up. But during the give-back periods historically, let's say over the next 2 to 10 weeks, wouldn't be unusual to see this data deteriorate again. That's just the way it works. Still, we need to see it improve. So this will give us some perspective. This is S&P 500 new highs minus new lows. Here's the low down here recently in February 24th, where my cursor is. This here is April 7th. So you can see the data started to deteriorate again over here. So how uncommon is it after a low or during a bull run to see this data near this blue horizontal line where we were on April 7th? It's not really unusual. Here's the COVID breadth thrust here. This is where we were on April 7th, the blue line. Stock market is killing it in here, and the data's lower than this line in many cases. Similar situation here. Markets advancing here. Get data that comes below the line after these thrusts over here. Similar situation here. The stock market does very, very well in this period, and this data down here gets weak from time to time. Having said all of that, see this look in here? This somewhat foreshadowed this big drop here in Q4 of 2018. So it's all relevant. This is a serious thrust here. So look at the data here after the low in 2009. This would be your very, very confident look, and the thrust really continues. This is your not so confident look, most likely with defensive leadership in here. And while the market rallied down here, this was useful information. So we'll just have to see how it unfolds. If you're a stock market bull, you really want it to look more like this over here and less like this over here or this over here. So we covered 7 new signals, gave us 40 new historical reference points, the data that we looked at 1982 to 2022. And like last week, it has to be said that the study periods have a bias towards 2009 to 2022. We have to know what we're looking at. And we're conducting this research to help us make better decisions based on our knowledge and experience. Just like last week, pretty fair to say these numbers down here, so this aggregates all of the signals, percent cases that were positive here, average return, median return here, looking out one month to 3 years. For the most part, the same conclusions as last week. And if we pull out these 2 cases here, not very similar to the present day, as you might imagine, these numbers down here, they don't change radically. They do improve a little bit. They're up here where my cursor is, and that just makes that bias even worse. You just have to know what you're looking at. So these are the 2 cases here that were removed. And just like last week, the past activity of some traders, the decision to proceed with that activity was taken in this context. The yield curve is a known, inflation a known, interest rates a known, Fed policy a known, tight labor market a known, supply chain issues known, no surprises relative to Russia or the energy markets. These are all still relevant, but they don't make any of this irrelevant. This is relevant, and this is relevant. We summarize these cases from a drawdown perspective. You can see as of the close on April 7th, we're really not seeing anything out of character. The further we drop below this line, and this horizontal line, the further we drift away from this script up here. And that's useful, because that means we could be moving toward a case like this or this. And typically, the drawdown occurred within 9 to 35 calendar days. So the fact that we're pulling back in this window towards these lines really doesn't drift from this script in any way. And we very well may drift from the script, and it may happen very, very soon, but it hasn't happened yet. There's nothing magical about these lines, and there's nothing magical about any of this. It simply helps us assess the probability of good things happening relative to the probability of bad things happening. Here's an updated look of the chart that we've already covered. This one is dated April 8th. Can't get much more indecisive than this. And relative to the drawdowns, the historical drawdowns, we're still well within this range denoted by the horizontal lines. Same concepts apply if we look at the hypothetical drawdowns based on this week's breadth studies. Also noteworthy, price above a now trying to turn up 50-day moving average in blue. Pretty fair to say that this look in here looks different from everything in here. Like these horizontal lines, nothing magical about these lines. There's nothing magical about the 50-day. It's simply a reference point. Should also be noted, acting as support doesn't necessarily mean you bounce or close above the line. Often you try to test that support in some way. The longer you stay below it, the more meaningful it becomes. And of course, this should be termed potential support. There's no question we'd like to see some improvement in the breadth data, but it should be noted we're making a series of higher lows on this breadth indicator here. There's no question we've seen improvement since this first spike down here in January. One of the reasons why we closed last week's video with somewhat sobering bullet points, because history and experience tells us that when the market's in a downtrend or in a correction or in a bear market, typically there's something that's bothering the market. And until something changes relative to those topics, it's difficult to get out of the period of malaise. Here's just a small sample of some of the bigger items that may have to shift for the market to get back into full-bore bull mode. We get readings on inflation that are below expectations. We get some loosening in a now tight labor market that's contributing to the inflation issue. Now, since interest rates front-run the Fed, it's possible rates could calm down on their own when they think they hit the proper level. As we mentioned earlier, haven't seen anything on this front yet. It'd be helpful if the energy market calmed down in a significant manner. And at any point during the rest of the year, or even into Q1 of next year, any slight shift to the dovish end of the spectrum from the Fed could send stocks higher and back into full-bore risk-on mode, something that we do not have currently, something that we have not had since the recent lows. Still may get it, we just don't have it yet. This would obviously be a positive development here. And if earnings came in well above expectations, that could give the market a bullish jolt. Given what we know today, it's probably fair to say that really none of these appear to be imminent right now. So to recap, based on history, we're still in the thrust window. That window is getting a little bit more narrow by the day. The initial thrust off the low, that's one of many steps that need to take place to get a sustainable push higher and a confident push higher. There's information in a defensive tape. There's information in this breadth data. This bullet point and this bullet point could improve if the S&P 500 can move away from that upward sloping 200-day. The look of the NYSE composite on Friday pretty much sums it all up. And everything that we covered last week still remains relevant. The data that we have in hand in this look here tells us it's really, really important to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.